this video, we're going to delve into Seth Klarman's investment rules, a legendary investor with an impressive track record, an annualized return of 20% over 30 years. You'll discover the strategies that have enabled him to achieve this success and how to apply them to your own investments. If you're looking to maximize your profits and build a solid financial future, this video is a must-watch. Before we dive into Seth Klarman's investment rules, it's essential to understand who this finance guru is. Seth Klarman is a renowned investor and hedge fund manager with a stellar career in the world of investments. Born on May 21, 1957, in New York, USA, Klarman has built a solid reputation in the financial industry over the decades. His focus on value investing and his prudence in taking risks set him apart in a financial world often characterized by the pursuit of quick gains. Seth Klarman earned his bachelor's degree in economics from Cornell University before continuing his studies at Harvard Business School, where he obtained his MBA. After completing his education at Harvard, Klarman began to forge his career in the world of finance. In 1982, he founded Baupost Group, an investment management firm based in Boston. Since then, Baupost has become one of the most influential and respected hedge funds in the world of investments. Now that we've explored Seth Klarman's remarkable career, it's time to dive into the investment rules that have been fundamental to his success. Invest, don't speculate. Imagine you're a passionate investor in the stock market. One day, you come across a tech company's stock that has been generating a lot of buzz in recent months due to its rapid price increase. All your friends and fellow investors are talking about this stock and how it could double in value soon. So, you decide to buy some shares of that company. Now, consider these questions. Why are you buying those shares? Is it because you've thoroughly researched the company, understand its business model and long-term prospects, and believe its true value is undervalued in the market? Or are you simply following the crowd, hoping the stock price will quickly rise so you can sell and make a profit? This is where Seth Klarman's first key point becomes relevant: the difference between value investors and speculators in the stock market. Are you a value investor who focuses on a company's fundamentals and evaluates its true value, or are you a speculator following market expectations and current trends? Value investors like Seth Klarman and Warren Buffett concentrate on thoroughly analyzing a company, its cash flows, its market position, and its long-term potential before investing. On the other hand, speculators may be more interested in market emotions and short-term price fluctuations. The next time you analyze a stock for investment, ask yourself if you're focused on its real value and fundamentals, or if you're simply following market trends. That reflection can have a significant impact on your success as a stock investor. Stock valuation. Imagine you're looking to buy a new refrigerator for your home. You're in an appliance store and see two refrigerators that appear to be exactly the same in size and capacity. However, one has a lower price than the other. Now, you face a choice. Should you buy the cheaper refrigerator without much thought, or should you research a bit more to ensure you're getting the best deal and quality? Just like when choosing a refrigerator, in the stock market, you have various ways to determine the value of a stock before deciding if it's a good investment. Seth Klarman mentions three main methods. Liquidation value. When evaluating a stock using liquidation value, you look at the company's assets and liabilities to calculate how much it would be worth if it were liquidated at that moment. This method is useful in situations where the company's tangible assets, such as buildings or equipment, are a significant part of its value. Market value. It's akin to comparing the price of a refrigerator to other similar models in the market. In the context of stocks, when analyzing market value, you compare a company's financial metrics, such as its price-to-earnings, P/E, ratio or price-to-book ratio, with similar companies in the same industry. If a stock has a lower P/E ratio than its competitors, it could indicate that it's undervalued. Discounted cash flow, DCF, analysis. This method is like estimating how much you'd be willing to pay for a refrigerator in the future and then adjusting that value to the present. When applying DCF analysis to a company, you estimate the future cash flows it's expected to generate and then discount them to their present value using an appropriate discount rate. Portfolio and cash management. Have you ever felt the pressure to make impulsive financial decisions amid a volatile market? Have you wondered whether you should keep your money invested in the market or hold it in cash, waiting for the right time to enter or exit? Seth Klarman addresses this dilemma and prompts us to consider the available options. Is it really necessary to choose between being all in or all out? Or is there an intermediate approach that allows you to keep some of your capital available for opportunities while staying invested in the market? One perspective that Klarman presents is to seek investments that offer consistent cash flows, such as dividend-paying stocks. This way, you don't need to be entirely in cash to have flexibility during times of volatility. The key here is to understand that it's not a binary choice between all or nothing. You can find a balance that suits your risk tolerance and long-term financial objectives. Be patient. The importance of patience in the financial market, as emphasized by Seth Klarman, lies in its significant influence on investment decisions. In a world characterized by volatility, constant information flow, and market pressures, patience emerges as an invaluable resource for investors. First and foremost, patience acts as a fundamental counterweight against impulsive decisions. In times of market turbulence, such as sudden drops or surges, emotional reactions can lead to hasty financial decisions that may prove costly. Furthermore, patience allows investments to mature and realize their true potential. Seth Klarman argues that many solid investments require time to bear fruit. This is especially true in the case of value investment strategies, where the goal is to identify undervalued assets and wait for the market to recognize their worth over time. Market pressure is another area where patience plays a crucial role. In an environment where information flows constantly and financial news can trigger rapid market responses, patience serves as a shield against the pressure to act immediately. Klarman argues that resisting the urge to make quick decisions in response to market events is vital to maintaining a long-term perspective and avoiding impulsive decisions. Lastly, patience allows investors to capitalize on market inefficiencies. In many cases, the market overreacts to news and events, creating opportunities for those investors who can identify and capitalize on these discrepancies. By waiting for the right time to buy or sell, patient investors can benefit from price fluctuations that do not reflect the real value of assets. Don't fear going against the market. The importance of not being afraid to go against the market, according to Seth Klarman's investment philosophy, lies in the pursuit of valuable opportunities and protection against excessive risks. Klarman is known for advocating contrarian investing, which involves making decisions that differ from the prevailing market consensus. First and foremost, this strategy allows you to identify undervalued assets that may have been overlooked due to the market's herd mentality. By not fearing to swim against the current, investors can find opportunities in companies or assets that have been unfairly punished or ignored because of short-term negative perceptions. This can lead to acquiring assets at lower prices and the potential for gains when the market eventually recognizes their true value. Additionally, this contrarian mindset can help avoid market traps, such as asset bubbles and overvaluations. When investors blindly follow market trends, irrational exuberance can lead to inflated prices. By not fearing to go against this trend and maintaining a critical view, investors can protect their capital from potentially devastating downturns when these bubbles eventually burst. Contrarian investing also fosters an independent and critical mindset. By questioning conventional wisdom and making decisions based on thorough analysis rather than following the crowd, investors can avoid impulsive mistakes. By adopting these rules and applying them diligently, we can be better prepared to navigate the challenges. Now, it's time for you to take action. Apply these principles, continue learning, and make informed investment decisions. Subscribe to our channel for more insights and updates on the world of finance.